I'm Matt Dicken, and this is Strategic Wealth. And now it's time for our Ask Matt Dicken segment. If you have a question, we're here to provide you answers. Please visit our website. If you go there, list your question, and we'll answer it here on the TV show, maybe on the radio show, but either way, I'll get back to you via email. So let's get started. Mark, what do you have for me?
Matt, our first question today is from David in Prospect. He writes, how much stock should an older investor hold?
Well, David, every situation is going to be a little bit different. Really depends on what your age is. We'd mentioned here on the show in the past, there's something called the Rule of 100, which says basically whatever your age is, that's the percentage of your retirement assets that should be in a safer position. And the difference between your age and the number 100 is how much money you could put at risk. So David, if you're 60 years old, 60% of your money should be safe, 40% could be at risk in the market. Obviously, if you're 70 years old, the ratios become 70-30. Now, you don't necessarily have to adhere to this rule if maybe you have pension income or some sort of other guaranteed rental income, things of that nature. But if you're relying on your retirement nest egg to provide the income that you need to maintain your lifestyle and your standard of living through your retirement, maybe your spouse's retirement as well, you want to try to adhere to this rule. And if you need more information on this particular subject, you can go to our Facebook page. We have several articles that we've posted out there that address this issue in more detail. So Mark, what do you have for us next?
Matt, our next question is from Susan in Louisville, and she writes, I've heard you talk about a strategic wealth report on your radio show. What is it, and is there any cost involved in obtaining one?
A strategic wealth report is what we refer to as basically an account audit. And what we're trying to do with the strategic wealth report is figure out exactly what the fees and expenses are that you're paying on your investments. We take a look at the fees, and we also take a look at the performance, because one of the things I mention on the radio show all the time is individuals don't mind paying some fees if you're getting really good value for that, meaning if you're getting good performance. But more often than not, what we will find is individuals are paying fees that are higher than what they thought they were, and the performance really isn't there to justify those fees. So this is something that's very, very valuable for anybody that actually has money invested in a mutual fund in particular. Maybe you've got money on deposit in a 401k where you work, maybe some money on deposit in an IRA at a bank or a stock brokerage firm, something of that nature. If you really want to know what all the fees and expenses are that you're paying, that's what this report will tell us. More often than not, it's much higher than what individuals originally thought before we ran the report. When you add management fees, trading costs, advisory fees, account fees, inactivity fees, when you add all of these different things that mutual funds and these different Wall Street firms have come up with, it's not unusual for us to see individuals paying 2, 3, 4, in some cases 5% or more per year in fees. So if you would like this report, you can request that we run one of these for you through our office. And it's not something that we charge anything for. These are not real expensive for us to put together. It takes a little bit of time, but they're not real costly for us. And over the last 15 years, we've probably run thousands of these reports, so it's something that we're happy to do for you as well.
Matt, our next question is from Alex in Clarksville. He writes, what is an appropriate annual fee for a money manager?
Well, of course, the lower the better, right? But sometimes fees are unavoidable. So if you're going to have any type of a management fee that you're paying to an advisor or maybe a mutual fund company, stock brokerage company, whatever it may be, you typically want to be below 2% per year. 2% is about the maximum you would ever pay or you would ever want to pay. But of course, the lower, the better. I would say on average what we see with mutual funds is 1.5% for a management fee. Most financial advisors are going to charge an additional 1 to 2%. So you want to make sure that when you add all your fees together, that you are basically all in for less than 2%. Of course, lower the fees are, the better it might be for you. But as usual, you sometimes get what you pay for. So just because there's a lower cost option out there doesn't necessarily mean that it'll be better. But you do want to make sure you're never in a situation paying more than 2% per year.
You're watching Strategic Wealth with Matt Dicken. It's Smart Money Television. Come see Matt live and discover what millions of safety-conscious Americans are doing now to protect and preserve their assets and make up for market losses. Will recent legislation changes affect your retirement? Can you safeguard your assets from unnecessary taxation? Can you find growth and security without risk in today's volatile market? Due to overwhelming demand for these events and very limited seating, we recommend that you call today, 855-MATT-DICKEN. That's 855-MATT-DICKEN, or go to AskMattDicken.com. You're watching Strategic Wealth with Matt Dicken. It's Smart Money Television.
Let's see what questions you had for us this week. Mark, what's the first one?
Matt, our first question is from Quinn in Louisville. Quinn writes, I'm investing more in my 401k than my company match. Is that a good idea?
Well, it's certainly not a bad idea, but it might not be the best thing for you to do. You know, we always recommend that individuals invest in their company's retirement plans at least up to the match. That's free money. There's nothing that we can do that's better than that. So you always want to take full advantage of that. But if you're putting more money over and above what the company matches, not a bad idea. It might not just be the best place. In some cases, you're better off going ahead and taking that money out, going ahead and paying the tax on it today, and maybe investing those dollars in a Roth IRA. That way you're going to have some pre-tax money and some post-tax money that'll give you more options in the future once you retire. So it's not a bad thing to do, just might not be the best thing to do, but what I would encourage you to do is talk to a professional and decide what works best for you.
Charles from Pewee Valley writes, do all financial advisors charge you for their time?
No, Charles, not all financial advisors charge for their time. Some do. What some individuals will do is just work on an hourly rate, or maybe you'll pay them a fee to put together a financial plan or something of that nature. But there's lots of advisors that you can talk to that don't charge. We're one of those advisors. Individuals can come into the office. We give a free consultation where they can ask any questions that they might have, and we'll see if we can provide any value. But typically, if you are going to get charged for their time, you're going to know that up front. Most advisors will tell you what their hourly rate is, or maybe what their consultation rate is. So you should know that before you even go into the appointment. But not all of them charge, but of course some do. Everybody's just a little different.
Our next question is from Paige in St. Matthews. She writes, I'm already retired. Is it too late to get a second opinion?
Well, Paige, I don't ever think it's too late to get a second opinion, nor is it ever too early. But especially once somebody goes into or is close to retirement, I think it's absolutely urgent that you do get a second opinion. Now, Paige, I don't know how long you've been retired, but if you're early in your retirement, typically those first 5 years are absolutely crucial. Unfortunately, I'll meet with individuals in my office all the time that have maybe been retired for 15 or 20 years, something of that nature, and now all of a sudden their monthly income is not high enough to cover all of their monthly expenses. And unfortunately, once you find yourself in that situation, there's little to nothing that can be done other than to reduce your overall living expenses, which means, of course, you have to reduce your standard of living and your lifestyle. So if you've recently retired, that's a great time. That's probably one of the most important times that you can actually go out and get a second opinion, because it's going to be the decisions that you make during the first few years of your retirement that will determine if you're going to have money that will last you forever, or you might find yourself in one of these unfortunate situations where as you get on in years and on in age, you're not able to have the type of lifestyle that you'd hope to have.
Matt, our next question is from Jason in New Albany. He writes, who manages a mutual fund?
Well, typically a mutual fund is going to be run by maybe one fund manager, or in some cases there will be a collection of fund managers. So these are professionals that this is really all they do. It's not typically a financial advisor. There's some out there that do that. But usually it's a specialist that's all they do. They run one particular fund. Occasionally you'll see them managing more than one, but it's typically just one fund, and they make all of the investment decisions. Now, of course, they're going to typically have a team. They'll have analysts and other individuals that are doing research for them. But in most cases, when you look at a mutual fund, it's run by only one person, in some cases 2 or 3. But I think of the roughly 10,000 funds that are out there, usually all the investment decisions are left up to one person. Now, the problem with this can arise is, let's say you have a good mutual fund that has really good performance. What happens a lot of times is that fund manager will be courted away, and the reason why that fund performed well has left, and now it's working for the next fund family. Of course, the fund that just lost this all-star fund manager is not going to notify you and tell you that the reason why the fund performed so well has kind of left the building and gone on to a competitor. So it is important, if you find a fund manager that you like, you have to kind of try and follow them and do the research and see which funds they're actually managing, because they don't always stay in one place.
You're watching Strategic Wealth with Matt Dicken. It's Smart Money Television. Come see Matt live and discover what millions of safety-conscious Americans are doing now to protect and preserve their assets and make up for market losses. Will recent legislation changes affect your retirement? Can you safeguard your assets from unnecessary taxation? Can you find growth and security without risk in today's volatile market? Due to overwhelming demand for these events and very limited seating, we recommend that you call today, 855-MATT-DICKEN. That's 855-MATT-DICKEN, or go to AskMattDicken.com. You're watching Strategic Wealth with Matt Dicken. It's Smart Money Television.
You know, once again this week, we got a lot of great questions. Please keep submitting them. Of course, you know that we're going to answer them here on the show or via email. So let's get right to it. Mark, what questions do we have this week?
Matt, our first question of the day is from Drake in Floyd's Knob. He writes, do you think that the government will be raising taxes in the future?
You know, once again, this is a subject that we've talked a lot about here on the TV show as well as the radio show. And I think taxes going up in the future at this point, unfortunately, is kind of inevitable. It doesn't matter whether Republicans or Democrats are in control of the Congress or the White House. I think eventually taxes are going to go higher. As we've mentioned before, taxes right now are kind of at historical lows. They certainly can't go any lower, but I do think that they will go up eventually. You know, if Congress does nothing, taxes are set to go up here in the near future anyway. But I think as we move forward, we have problems with unfunded liabilities with Social Security, Medicare, Medicaid, debts and deficits as far as the eye can see. I really, unfortunately, believe taxes are going to go higher, although I don't want to see them go any higher. So what does all this mean? Really what you want to do is you want to take steps today to minimize the impact of higher taxes that could potentially come in the future. So again, you want to make sure you do not have too much money in taxable accounts like taxable CDs, money market accounts, taxable mutual funds, things of that nature. What's really best is to try and take advantage of every tax-free investment that you have available to you today. That could be a Roth IRA, maybe a municipal bond. Certain overfunded life insurance contracts can grow tax-free. So you want to move as much money as you can today from a taxable environment into a tax-free environment. So potentially in the future, if taxes go a lot higher like we've seen in the past, then it won't have as big of an impact on you. So it's something that you have to plan for now before it's too late, because if taxes do go a lot higher in the future, at that point, there's little to nothing we can do. You're just going to have to pay the tax bill. But there's things that you can do now to get prepared for it, and that's one of the things we cover with individuals when we meet with them in our office.
Matt, our next question is from Julie in Sellersburg. She writes, why are there so many different kinds of annuities?
Well, Julie, that's a good question. You know, it's kind of like mutual funds. There's a different variety for every different type of investor that's out there. Kind of the same thing with annuities. You can have fixed annuities, index annuities, variable annuities. It really depends on your situation as far as which one's going to be more appropriate for you. And every investor is a little different. Some of them don't mind having a lot of risk in their portfolio. Maybe a variable annuity could be appropriate for somebody like that doesn't mind kind of watching the ride of the roller coaster in the stock market as their money goes up and goes down. If you want less risk or you don't want your money to go down in value, then maybe a fixed annuity might be appropriate. Now, the fixed annuity is going to be appropriate for somebody that's maybe a little risk averse. They don't ever want to see their account go down in value. Maybe a fixed annuity would be good for them because there's going to be some sort of guaranteed interest rate. Now, right now, interest rates are at historical lows, so fixed annuities aren't paying a whole lot, but again, you don't have to worry about losing anything. And then typically you'll find index annuities as an alternative as well. This is for somebody that doesn't want to lose any money, but they would still like to have more upside potential than what a fixed annuity will pay right now. With an index annuity, what you get to do is participate in the growth of the market when it goes up, but you don't ever participate in the market when it goes down in value because you have basically a safety net on the account. Now, with any annuity, you're going to have some sort of a time horizon that you have to agree to before you take all of your money out. And typically, that time horizon means you're going to have to wait maybe at least a year before you make any withdrawals to as much as 10 years before you make withdrawals. Everybody's got different risk tolerances and different time horizons, so there's really a different annuity out there for each investor that we might talk to. Now, a lot of people are familiar with fixed annuities and variable annuities, but most people don't know a whole lot about the index annuity. So this is why a couple years ago, we actually authored a consumer's guide to index annuities. If you want more information on these accounts and how they work, what the buyer's guide will do is give you information about what to look for in an index annuity and what to avoid in an index annuity. So Julie, I'm really going to encourage you, if you have questions about annuities, or really anybody for that matter, contact the office and request the buyer's guide. I think index annuities are probably one of the best kept secrets in the financial services industry, and it'll give you a lot more education than what we can go into here today.
You're watching Strategic Wealth with Matt Dicken. It's Smart Money Television. Come see Matt live and discover what millions of safety-conscious Americans are doing now to protect and preserve their assets and make up for market losses. Will recent legislation changes affect your retirement? Can you safeguard your assets from unnecessary taxation? Can you find growth and security without risk in today's volatile market? Due to overwhelming demand for these events and very limited seating, we recommend that you call today, 855-MATT-DICKEN. That's 855-MATT-DICKEN, or go to AskMattDicken.com. You're watching Strategic Wealth with Matt Dicken. It's Smart Money Television.
If you've got questions, you can visit us on our website and submit your questions to us. I'm either going to answer them here on the TV show, maybe on the radio show, but either way, we're going to get back to you with a response. Mark, what types of questions do we have this week?
Matt, we have some great questions this week. First off is Linda from Louisville, and she writes, on a previous show you mentioned that it would be most likely a slow few years ahead and maybe time to invest in things that pay 6 to 9% interest. Can you give me an idea of what pays 6 to 9% interest?
Well, of course, Linda, it depends on the situation, but there are still a variety of things that will pay a reasonable rate of return. Like we've mentioned in the past, that might mean a bond. You know, there's concerns about interest rates going higher, so you have to be very careful with bonds, but you have different types of corporate bonds. In some cases, maybe you can find municipal bonds paying a reasonable amount of interest. What you typically want to do is try and stay with short-term maturities, so don't go with any long durations. It used to be that CDs would pay a reasonable rate of return, but not right now. It used to be historically interest rates on CDs were much higher than where they are today, so we would avoid those typically unless you just want to invest emergency funds in CDs. That's a good temporary parking place for money. Another alternative could possibly be a preferred stock or maybe a dividend-paying exchange-traded fund. Some of those will pay interest or dividends in the 6 to 7, in some cases 8% range. And then of course you have different types of maybe fixed or indexed annuities that have income riders, where you can have guaranteed interest on an income account value of maybe 6 or 7 or 8%, but everybody's situation's a little bit different and those aren't necessarily appropriate for everyone. So before you go out and invest in any of these types of vehicles, you definitely want to talk to a professional to explain to them your situation, what your risk tolerance is, and they'll help you identify which one of these areas would be appropriate for you. But you can still get a reasonable return, even in a difficult stock market like we're experiencing right now. Mark, what's the next question?
Matt, our next question is from Michael in Shelbyville, and it's actually a three-part question. The first part is, my money is tied up in a 401k and a cash account, and I will be retiring in 2 years. Would you recommend seeing an advisor now or waiting until after I retire?
You know, if you're within 2 years of retirement, I think it makes sense to go ahead and sit down and start talking with individuals now. It's never too early to start planning your retirement. Now, the one thing that I would definitely avoid doing is waiting until the day after you've retired to start to seek individuals' advice. We've actually, in the past, we've talked about a 20-point checklist of things that you should do prior to your actual retirement date. If you need that checklist, you can request it and we'll send it to you out of our office. But I wouldn't wait. We can meet with you now. Obviously, the earlier we start, the better job we can do of helping you transition successfully from working into your retirement years.
Matt, the second part of the question is, are you fee-based or commission-based?
Well, that really depends on the situation. You know, we can do things either way. Sometimes if individuals would prefer to pay commissions up front and not have ongoing fees, we can do that. Other individuals don't want to work with a commission-based advisor, and in that scenario, we can do things in a fee type of scenario where they just ask us to do certain things for them. We'll provide them a price, and then they can tell us yes or no if they want us to do that. So we're not restricted to just one way or the other. We could do it either way depending on the client. Now, Michael, there's even a third alternative where you don't have to pay commissions or fees. Myself and other advisors sometimes will have account options where you can invest money, and because you've made a time commitment, you're not going to have to pay any fees and you're not going to have to pay any commissions either up front or on an ongoing basis. So sometimes you can avoid having to pay any types of fees at all. Once again, though, you want to talk with a professional and learn about the pros and cons of each of the different ways that you can invest money.
Matt, the last part of Michael's question is, are you a registered investment advisor?
Well, we do work with a registered investment advisory firm, so I'm what's called an investment advisor representative. So from a regulatory standpoint, I do have a fiduciary responsibility to my client. And that's a really good question. We've talked about it here on the show in the past. We've covered it on the radio show in the past as well. there's a difference between advisors. If you work with a registered representative of, say, a bank or maybe some sort of a stock brokerage firm, they have a fiduciary responsibility to the firm that they work for. A lot of times individuals think that financial advisors all have to act in the best interest of their client. Unfortunately, that's not the case. But if you do work with someone that's affiliated with a registered investment advisory firm, they do have a fiduciary responsibility to the client, which of course means they have to do what's in the client's best interest. It's a very big difference, and a lot of investors just don't realize that there are two options that you have as far as fiduciary standards when working with a financial planner. That's a great question.
You're watching Strategic Wealth with Matt Dicken. It's Smart Money Television. Come see Matt live and discover what millions of safety-conscious Americans are doing now to protect and preserve their assets and make up for market losses. Will recent legislation changes affect your retirement? Can you safeguard your assets from unnecessary taxation? Can you find growth and security without risk in today's volatile market? Due to overwhelming demand for these events and very limited seating, we recommend that you call today, 855-MATT-DICKEN. That's 855-MATT-DICKEN, or go to AskMattDicken.com. You're watching Strategic Wealth with Matt Dicken. It's Smart Money Television.
If you have any questions that you would like to see aired here on the show, please visit our website. We've got an icon that you can click on. Submit your question to us. We're going to answer it on the show, maybe via email. Either way, we'll get back to you with a response. Mark, what types of questions do we have this week?
Matt, once again, some tremendous questions that came in via the website. Our first one is from Alice in Louisville, and she writes, I am recently widowed, and I'm very concerned about keeping my money safe. Where can I find safety and security in today's market conditions?
Well, Alice, thank you for submitting that question. I know it's a very difficult time that you're probably going through right now. I would recommend that you definitely sit down and talk with a professional, both with yourself and probably with another family member. You're going to have a lot of decisions that you're going to have to make right now that are going to impact the rest of your life, whether you're still working or retired. So you want to sit down and talk with at least one or two professionals. Of course, you're going to need to go back and update things like wills and trusts. You're going to need to change beneficiaries on your accounts. There's a lot of things, a lot of decisions that you're going to have to make. Try not to go it alone. See if you have a child or maybe a brother or a sister or a parent, depending on your situation. Try and take someone with you and sit down and talk with at least one or two financial professionals and figure out a game plan as far as what you should do different now that your circumstances have changed. Now, Alice, if you're really concerned about safety and security with your retirement assets or your investment assets, you really have a few different options that you can choose from, or maybe a mixture of a few different things. Obviously, things at the bank such as CDs, money market accounts, savings accounts, those are going to be safe. Unfortunately, right now, they're just not returning very much interest. So you might want to take a look at some other alternatives such as different types of bonds. There's different levels of risk with bonds, so you can find some, especially government-backed bonds, which will have little to no risk, depending on your situation. You also have things such as preferred stocks or dividend-paying ETFs or exchange-traded funds. The way that you can typically keep those types of positions safe is you put what's called a stop loss on them. So they're not guaranteed that they can't go down in value, but you can set it up to where if things were to start to go bad in the stock market once again, you'll be sold out of those positions. You don't have to worry about losing a large amount of money if you have a stop loss. There's some risk involved with those types of investments. Another alternative might be fixed or index annuities. We do a lot with index annuities in our office. They're not appropriate for everyone. But when we talk with somebody that's looking for safety and security, but they're still needing a reasonable return, meaning they want to at least keep up with and outpace inflation, a lot of times we've recommended these types of accounts, but of course it really comes down to your type of situation. So going back to what I said earlier, you want to make sure that you sit down and talk with a professional.
Matt, our next question is from Sergio in Goshen, and he writes, our advisor hasn't called us in over 2 years. Is that normal? How often should someone get together with their advisor?
Well, Sergio, I think 2 years is probably a little too long to have heard from your advisor. You might want to double check and make sure that they still work for the firm that they were with when you first met them. It really depends on the client as far as how often you should get together with your advisor. We have clients in our firm that want to meet with us just once a year. They'll tell me, Matt, if everything's going the way we want it to go, we don't need to hear from you. Of course, they get statements and things of that throughout the year. But as far as a face-to-face meeting, some clients just want to meet once a year. Now, others want to meet more often than that, and that's fine. Some clients want to meet with us quarterly, others want to do it twice a year. Really doesn't matter. If they have something that changes in their life, then of course they can come in and meet with us in between our scheduled meetings. So it's really up to you as far as how often you want to sit down and talk to your advisor. I would recommend not going over any more than just 12 months. A lot of things change in your personal life and in the economy and the stock market. Different investment options might become available, things of that nature. Tax laws change. There's a lot that happens over the course of a year. So at a minimum, it should be at least once a year. In some cases, you need to meet more often than that.
Matt, our next question is from Geraldine in New Albany. She writes, "My attorney is giving me different advice from my current financial advisor. How do I know who to listen to?"
This is a difficult question to answer because it really depends on the advice that you're getting. Attorneys can give you great advice as far as wills and trusts, different estate planning needs, things of that nature. But I hear this type of question all the time. Now, whether it's an attorney giving advice, sometimes it's a CPA, sometimes it might be a rich uncle or a next door neighbor. We really encourage you to take a close look at who's giving you the advice and make sure that they are a credentialized professional. This is one of the biggest problems that we see that individuals have today, whereas they're taking financial advice or retirement advice from individuals that really aren't qualified. Now, they might be really trying to help you. They might be really nice people, but the information that they share with you might be good advice for their situation, but it might not be the best advice for your particular situation. So you want to make sure that they're a true professional, someone that has a lot of experience in working with individuals that are in your particular situation. If you are closer into retirement, you want to work with somebody that has years of experience in helping individuals that are in that scenario. Maybe if you are a younger investor and you're just starting out, well, you might need a different advisor than who your parents work with. You might want to work with somebody that can show you ways to take advantage of the fact that you've got a long time before you're going to retire. So you need to make sure that the person that you're listening to truly is qualified to give the advice. Sometimes that would be an attorney or a CPA, but more often than not, it's going to be a qualified financial professional. And once again, it brings us to the end of another wonderful show. Now, if you've missed anything in this week's show or you'd like to see previous shows, you can see them on our website. And keep in mind, retirement planning is a journey, not a destination. We'll see you here next week.